Good morning and welcome to the May installment of Breakaway Funding's educational webinar series. This is Kim Castiglionis, the founder and managing partner of Breakaway Funding, LLC. We are delighted you have joined us this morning. Breakaway Funding was created as a result of a two-pronged problem I encountered as the CEO of Circle Bank. First, lack of access to capital for our country's jobs creators, namely our small businesses, and second, community banks struggle to lend. I recognized that a fully integrated crowdfunding platform would serve to match investors with businesses requiring capital to strengthen their balance sheets and position those businesses for funding by traditional lending institutions. More about how we accomplish that in a moment. You know, there is nothing quite as demoralizing and depressing than investing a lot of time, energy, and effort preparing to present your company or idea to a group of potential investors, only to walk away with the impression they had no appreciation as to how cool, game-changing, scalable, and successful your idea was. They asked no questions, and you thought you would never hear from them again, until you received this message. Thanks, Company X, for sharing your proposal. This is not the one for us. Best of luck with the fundraising and stay in touch. But that stops today. We are pleased to have with us an expert in the field of designing and presenting private equity deals that do get funded, and we will hear from him in just a moment. To help set your expectation for this morning's event, I will begin with a brief description of Breakaway Funding and its services, followed by a short audience poll. That's where you come in. I will introduce our presenter. We will allocate some time for questions and close with some wrap-up thoughts. Breakaway Funding is spearheading an innovative platform that creates a new and thriving online investment community we call the Community Capital Marketplace. It is the engagement of all members of our communities, investors, business owners, and entrepreneurs, and community financial institutions collaborating to ensure capital is made available to propel innovation, job creation, and to provide new opportunities for investors. Our platform is a complete capital raising ecosystem and investing ecosystem, providing a standardized process for raising capital, leveraging technology to help drive down the cost for issuers, a comprehensive and transparent due diligence system and analysis tools to help investors make informed decisions through a secure, convenient, and regulatory compliant website. And finally, this marketplace is designed to provide community banks and commercial credit unions with a steady stream of new client relationships. Now, we believe that everyone should have access and the ability to invest in startup and early stage companies they believe in, whose mission is aligned with their values and in which they are legally eligible to invest, perhaps companies like yours. And to help you prepare for and participate in this exciting new marketplace, we provide a full complement of services and support, from free educational webinars like today's event to post-raise investor relations care. Now, with that in mind, let's get started. We would like to know, by a show of responses, how many of you are preparing for or have already pitched to angel investors or venture capitalists. To answer, please use the conversation box to type your response. We will share your answers during our question and answer session. Again, we would like to know how many of you are preparing for or have already pitched to angel or venture capitalists. Now, to help us navigate the minds of investors, it gives me great pleasure to introduce our guest presenter this morning, Che Voigt, Board Chair of North Bay Angels. Che has been an angel investor for nearly 2 decades. He is the founder of Crossover Ventures, which focuses on active investments in high-growth companies. What active means, I think I'm going to save that question for him for later. He is the president of Altwork, a startup in the office furniture space, and he has seen thousands of pitches from entrepreneurs. Che, we are looking forward to your comments and your guidance. Welcome.
Thank you very much, Kim. I wanted to talk a little bit about angel presentations that get funded today. This is a passion project for me. I grew up in an entrepreneurial family. I really felt like we could do something better than we had done previously, and I got involved with the North Bay Angels to learn about that process and to really make our entrepreneuring efforts better. And one of the things that I've seen literally for years and years now is these very poor presentations from what might be a good company, what might not be. So what I say here is bad presentations make good companies look bad. A good presentation about a bad company idea means you're at least articulating the idea properly and in a way that can get comment on, and then you can fix it. But if it's a muddy presentation, you can't tell if it's a bad idea or just a bad presentation. That's what we're going to talk about today. What we're trying to do here is get better presentations to angels, which will help the entrepreneur get better communications with angels, which will help the angel get better angel investments, which will hopefully lead to better exits for everyone involved. So first, a little bit about North Bay Angels. North Bay Angels is the oldest and largest angel investment group north of the Golden Gate. We've been in continuous operation since 1998. You can imagine that means that we've been through some boom and bust cycles that will, it's a good learning experience. How's that? And then to give you an idea of what we do, last year our members, we're a group of angels where members make independent investment decisions. We do not do a sidecar fund, nor do we have a fund where we vote or anything like that. These are individual angel members making individual angel investment decisions. However, our members collectively invested $9.1 million in 2014 in early stage type investments. That's angel investments, follow-ons, venture funds, their own small business angel investment types. And first, before we start, I feel it's appropriate to give a couple of disclaimers. So fundamentally, everything is different this time, but we've been through a couple of cycles, and so everything's the same. And that means that the advice that you may hear today may work in today's environment, may work in an environment that isn't quite here yet, may not be appropriate if we go through another bust cycle, all of those things. So please keep that in mind as you are looking and thinking about this. I've tried to distill down to the very core of what I think successful angel presentations need to have in them. However, the timing changes and the environment changes. Number two, my presentation is focused on our version of angels, the North Bay Angels version of angels. These are usually individuals with past successes looking to help entrepreneurs. I see my work with entrepreneurs a little bit as community service in addition to an investment. I want to help the people that were like me because the people who helped me in the past, I really appreciate the work that they did, and the best way that I can do is by so-called, pushing that ball forward. The other part about that, usually these angels are invested in, organized into groups, but not necessarily. Usually these are maybe 25K to 250K check writers, maybe a little bit lower, maybe a little bit bigger, but this is not centered at VCs or mini VCs or the traditional super angels that have come into play. I look at this as the classic angel model. And then finally, of course, these are my views, and if you ask 10 angels, you'll get 20 opinions, and if you call them the next day, you might get some more. So, this is my best effort of my views, but you'll always have a different input from different people. So, back to angel presentations that get funded. What's the plan to get there? I'm going to present each slide that I have. We'll talk about what's needs to be in your presentation from my point of view. What are we as investors really looking for? And then second, I'll tend to give you what is the question that we're thinking about in the background. What do we talk about after the entrepreneurs leave the pitch session and say, well, what about this and what about that? And then my individual view based on my background as a mechanical engineer with aerospace background. What are the kinds of things that I think about personally? So to start this out, we're going to look at the landscape, or the analogy I use is who's at the table, right? So we have this conference table, and there's really three entities at that table. Most people only think of two. So first, obviously, we have the entrepreneur or the entrepreneurial team, someone with a bright idea. Then we have the investor or investors, depending on the format. These are people who are looking to help the entrepreneurs. They're looking to have a return on their capital. It's an investment, not a scholarship. And then finally, we have the process, right? So there's some process that brought people there. So first, we have the entrepreneur. The entrepreneur is looking for funding. They're looking for help. They need the 99 doors closed in their face so that one remains open. They also are very busy. They need to make sure they're actually closing with a real investor, not someone that maybe is a consultant or maybe is not really interested right now and they're just being polite. They need to be sure they're closing. And then finally, what we find is in many, many cases here, most of the entrepreneurs that come through the North Bay Angels are still learning about funding as they're trying to fund their deal. So they're in a challenged environment because they've gotten some advice in one place and then they're getting different advice from somebody else, and it's really a challenge to learn about funding. So we spend a lot of time explaining and trying to help the entrepreneur come up with some terms that will work for them. The next person at the table is the investor. So this person's looking to help promising entrepreneurs. Emphasis on promising. There's a lot of people out there that want to be entrepreneurs. Most of them, by definition, by statistical evidence, will not make it. So she's looking to help promising entrepreneurs. We are looking for great deals. I used to say good deals, but I now just say, look, we're looking for great deals because we're all jaded. Everything looks worse later down the road, so if it looks really great now, it'll probably keep going. And then finally, politely but jealously guard their time. In general, there's more demand on an investor's time by various promising entrepreneurs than that person has time to be able to give. So there's a jealous guard on that. However, I would like to believe, and from the evidence that I've seen, most investors tend to be pretty direct, but they're trying to be polite and helpful at the same time. So it's not the Shark Tank type of mentality. It's more of polite but jealously guard the time. And part of that is because even a deal that doesn't look great today, if that team goes back and refines some of it, it may be great in a few months or next year or the next deal or whatever. And this is a long-term relationship between investors and entrepreneurs, and that's I think that we all take the long view. So polite is important. Finally, there's the process. So to me, the process is important because there's a process that got you there. It could be very informal, such as you got introduced to a friend of a friend by some other friend. In order to do that, you want to respect the people in the process. It could be very formal. North Bay Angels has a significant pre-screening process, then we do a screening meeting, and then finally we have the actual event, the dinner meeting that we do, and then we have follows up. It's important to respect the process and not to be too good for the process. Now getting into the presentation itself. So I like to start with the overview. This is a really hard thing to start with. This is a one slide that says it all. And by saying it all, it talks about the company, the product, and the investment, why all of these things are great, and it's trying to capture the attention of the investor right in the outset. The thing that is important about this is if you can do that in one slide, what investors are thinking is this team was able to capture my attention in just a few words or pictures or both, and they really understand their concept. They can articulate it wonderfully. If they can articulate it to investors, then that means they can articulate it to customers. That means they can articulate it to prospective employees, partners, etc. My view is it's simply a test of focus. It's really hard to do. I love the Pascal's quote, which is, "I'm sorry I had to write you such a long letter. I did not have time to write a short one." Rambling ideas about how things could work means they haven't really been focused. And if you can get a really great overview slide to start out the conversation, it's fantastic. So The next thing is the pain and the market fit. And I do want to take time to say that I'm not trying to create a template here for people. Every deal, every management team has their own strengths and weaknesses. What you should do from a template point of view is lead with your best differentiator, whatever that is. So please don't try to take this as a template to say, oh, great, we're going to put it in this structure because Che said so. That's not my intent. These are the things that good presentations that get funded have in them, and they're interwoven within that presentation in an appropriate way to keep the conversation flowing. So every good presentation needs to talk about what is the pain in the market and how your product is going to solve that. But first, what is the pain? You need to show that you understand the market. You need to show that the market is large enough to support the plan, whatever that plan is. And in many cases, there's a lot of really good ideas that are really hard to launch because of government regulations, because of market dynamics where there's a few customers that don't wish to change. These are the kinds of things where great products, great technology end up dying. So market dynamics need to support a new entrance. So the kinds of stuff that investors are thinking about at that time is this pain enough for people to part with their cash, right? Some problems are problems, but they're just simply not painful enough for the people to part with their cash. And then number two is the people that are affected by the pain and have the money to make do they have the money to part with in the first place? So this is back to the idea of you need to sell things to people that have money to buy them. Now, sometimes that means you're selling indirectly. The person that purchases the product, if you will, is not necessarily the person that uses the product. We see that in several social entrepreneurial type of deals, and those are great ways to fix that problem because there are ways to fix it, but we have to make sure the customers have money. And then finally, in my view, I look at this in terms of, can the team predict the market? Right? Markets are fluid by definition, right? And they're more fluid now than they've probably been in a long time. So not only can the team describe the market, to me, really good teams are able to predict the market and show, hey, this is where it's going to be, and this is why what we're doing now matters. Not it used to matter, but that fight's over. It's going to matter, and right as we launch, it's going to be really important. The other part that I look at here is how much is customer acquisition cost. The so-called CAC is really important. Pain and market fit are directly related to your customer acquisition cost. Customers with lots of money and a lot of pain have cheap acquisition costs, right? And this is really important, especially for SaaS companies. We see a lot of SaaS companies come through. The SaaS model works better and better the more mature the company is. So startups have trouble with high customer acquisition costs and low customer ROIs. So something to keep an eye on. And I mention this because I've learned this through painful lessons. Next, let's move on to the competition. So obviously, your presentation has to show that your product or service is differentiated and superior, right? That's obvious. The other part is you need to show where the competition is both strong and weak, right? Smart entrepreneurs know that competition should be respected, and they may be ignoring a part of the market that you think is really important, but they're ignoring it because they don't think it's important. So understand and respect your competition where it's strong and weak. So what are investors thinking after the pitch? We typically are thinking about competitors are not static. What will they be doing? What will they be doing soon? What's in their secret back room? What's one of their change agents working on? Those kinds of things. That's always a possibility. It's always scary to an entrepreneur because they can't know everything, but they can know a lot. So investors will often talk about, well, that entrepreneur presented a great study of where the competition is right now, but what are they going to be doing? Again, that's back to how is the market going to be predicted. The next item, a lot of times we'll see a presentation and it will talk about the competition, and the issue is that the competition, if the pain isn't high enough, the customer may just decide to do nothing. So sometimes doing nothing is an option. Finally, a personal pet peeve also, but investors often talk about this, when an entrepreneur loves to come in and say, we have no competition in this market. And sometimes that's because they've narrowly defined the market so small that they don't have any competition because it's this tiny little niche, or sometimes they don't see the doing nothing as a competition, whatever it is. But in general, if you believe in efficient markets, it tends to mean no competition means no market. So be very careful about the idea of we have no competition. And then finally, in my view, competition is focusing for companies. And it's focusing because it's a great way to say, okay, what is our strategy to beat this respected competitor? If we can articulate that way, then what we can do is say, okay, we're going to beat them this way. This is what we can do that they cannot do, etc. Number two, the realistic competition as the customer sees it. The company's version of the competition is really not as important as the customer's vision of competition. And then finally, in a little bit of a story from my own history, we were lucky enough to sell a company, and as we went through that process, we went through the antitrust investigation with DOJ, and the investment banker on that deal called me and she said, look, this is what's going to happen. I really need to know from you if you ever presented in any of your investment pitches any indication of the word dominate, that you were going to dominate this market. And I said, no, we didn't. We're just trying to survive as a small company in a very competitive environment. She said, well, that's good because that's one of the key words that they look for. So you might want to think about that. If you are successful, how is DOJ going to take a look at your documents, and what are they going to feel about your words? Next, we're going to talk about product development. Almost by definition, sometimes the product's fully developed and just a sales channel needs to get worked out. Most of the pitches that we see from an angel investor point of view, the product is mostly developed. There's at least a sophisticated prototype or an initial product run, but there's going to be some improvements to that product, right? So if you need to develop your product, if you have use of funds going to that, make sure you show where the product development is now and what you need to start selling the product. I love the concept of minimum viable product, or MVP. I think it's a really important place for entrepreneurs, especially entrepreneurs like myself with an engineering background, that feel as if maybe they should just keep featuring the product up. We fight about that a lot. What we really want to do here is, what do we need in order to effectively sell a product that makes the early adopters happy enough to promote our product in the future? Sometimes that means we'll need to fix it or upgrade it via software. That's easy. Hardware products are a lot more difficult to do that. But what do you really need to just start selling? Not the vision of your perfect product, but to start selling and making customers happy. Once you have that goal in mind and articulate it, then we need to talk about, well, what is your plan to get there? And sometimes, people talk about barriers to entry. IP is certainly a barrier to entry. It's an important barrier to entry. Development and the challenge of development is an important part of the barrier to entry, right? So if something didn't take you very long to do, it means that your competition won't take very long to do it. Unfortunately, for human beings, once they see something done the first time, it seems that they're faster to be able to copy that. But still, difficult product development is a barrier to entry. Now, what are the investors thinking? Number one is this a team that's shown that it can get things done, right? Products are hard to develop. Services are hard to develop. Companies are hard to develop. Is this a team that's shown it can get things done? And then number two, nobody thinks that the product's going to get developed early. We all know that everything's hard and it's going to slip. So when that happens, can the company survive that schedule slip? You need to be able to articulate that either in reserves, in your financing, or a early and late delivery, those kinds of things. Now, my view, I have an aerospace program management and engineering background, right? So I think about things in terms of risks and risk retirements. And that's a big deal when you're talking about product developments. When you have a prototype, what risks did you retire, right? What did you say? Well, we don't know if this is going to work. We don't know if this is going to work. We tried this 3 times. Now we finally got it working. Those are risks that you've retired. Now, in addition, you'll still have risks ahead of you, and some of those will be easier than others. But I like to see people think about their product development in risk and risk retirement. That's a personal way. And then there's a lot of good advice out there about not doing a tag team presentation and just having one person talk. But if you are going to do a tag team presentation, I always like to see the technical people talk to product development in the presentation. Now moving on to marketing strategy. So when we talked about pain and market fit, that's the landscape of the market that you're trying to enter into. The marketing strategy is your entry into that. So your presentation has to show what your strategy is. Just in summary, but clearly articulated, we are going to enter the market in this way. We are going to pursue these traction channels. We are choosing these traction channels because we've tested them, we've gotten good feedback, we think they will work something. So what has been accomplished? And then what lessons are learned? So what investors are thinking is, one, is the marketing strategy capital efficient? Marketing strategy is one of the easiest ways to get very confused and spend a lot of money in something that's not very effective. So there's no defined way to say, I'm going to pour money into this marketing area and I'm expecting these results, because it's always changing. Your competition that made something work before, it's now saturated. So if you use the same thing that worked last year, you're probably not going to be able to make it work this year because it's noisy, right? So it comes down to, has the team shown its ability to adapt? For me, at least, I look at marketing and say, this is probably the most important area to show that you can try something, design an experiment, look at the results, and either double down on it or decide to try something new and move quickly, very, very quickly. And that's never been easier than today's world of digital marketing. So in my view, more important than most people think. Easier now with more data-driven answers than there's ever existed, but that just means you have to move faster. And then finally, capital inefficient plans are easy to develop and a real problem. I've literally seen people talk about how they're going to advertise on broadcast TV, and in today's modern world, I just don't think that's going to work for you. Now let's move on to your winning team. I don't even talk about it as your team. So you got to show that you are the team to do it and that your team can work together. One of the biggest risks that any startup company has is it's a high stress, difficult environment. Things go wrong. It's very challenging. You have to show that your team can stick together and win. The best way to do that from an investor point of view is to show that this team has worked together and done it before. It's awesome when you see a team say, hey, this team worked together, we had an idea, we got it funded, we built it up, we sold the company, we're now going to do it again. That's the best that can happen. And then if you think about if your startup has a significant chance of seriously pivoting and seriously changing, then really investors are betting on the team, not on the individual product. And that's the idea of bet on jockeys, not on horses. I'm sure you've heard that before. And then in my view, people working well together will make you stand out. And, things will happen. You're going to be up in front of a dinner meeting and the mic will stop working or the slides will stop working or something will happen. And it's always devastating to watch three people stand on the side of the room, supposedly part of the team, while the CEO is trying to get her slides to work. These are the times where you hand off the baton, you show that you can work together seamlessly without power struggles, etc. I have literally watched teams fight in front of the investors about in presentations. Those are really easy decisions to say, I don't even think they're going to make it through the week, let alone through the investment. And then finally, I'll end this slide with my Anna Karenina quote that I like so much, which is, happy families are all alike, and every unhappy family is unhappy in its own way. I do a lot of thinking about this quote, and one of the things that I think about on this one is effective working teams are effective and working. Broken teams can be broken in so many different ways that it's hard to say what's wrong with them. So I don't have a formula for what an effective team is other than it's effective, right? And some teams work well together and everybody's having a great day. Some teams work well together because they yell at each other all the time and they're trying to prove each other wrong, but they're still effective. So any kind of team can be effective, but they just have to be effective. Moving on to the financials. So you would think that a company, financials are the basis of a company, right? That's how we measure our performance and make sure that we're going to be in business next week or next day. I have seen presentations where people don't have any financials. It's crazy. So your presentation must show a summary of revenue, COGS, SG&A, overheads, EBITs, all that stuff, and everybody on your team needs to understand those well enough. It is simply unacceptable for someone to say, well, I'm technical, so I don't have to worry about any of that. And it's like, look, you're technical. You're probably designing in most of the cost of goods sold. It's really important you understand how all these things work. Number 2 is the cash forecast. We'd love to believe that revenue mattered to a startup company, but startups die when they run out of cash. So the cash forecast is really important. 3 to 5 years for the pro forma is great. You need to have something in there to show where the vision of this company is, right? The so-called hockey sticks, nobody really believes the hockey stick, but what they really care about is what are the drivers to the financial? What are the assumptions based on this one? And then the other thing that I do recommend, a lot of companies will come and they've already have history, a couple years in the market, maybe with a different product, whatever it is, but you have to show your past financials. Even if your past financials have issues, it's much better to talk about them and disclose them and say this is why we're going to do better than it is to hide them and see if they aren't noticed in due diligence. And then, so what are the investors thinking? So one of the issues is this consistent for the market, right? So if the market is generally struggling to make 10% EBIT by paid professionals that are working every day to make that EBIT higher, and a team comes in and says, well, we don't really know how to stack our costs, so we're just going to say that we're going to make 50% EBIT because it seems like a good idea, then it probably means the team doesn't get it about running the business. They don't really understand where the money's going to go, and if they don't understand where the money's going to go, they can't really ask for the right amount of money in order to make a successful company. They just don't, quote, get it. Finally, in my view, your financials should show how you can make $1 equal 2 or more, right? That's that idea of this is a great deal because we have these ways to kind of trick the system in order to get us much more value than we have to pay for. And then finally, for reasons that I don't quite understand, there's a $50 million mental barrier that a lot of entrepreneurs present, where their revenue goes up to $50 million and that's it. It's not consistent with the market. The market's much larger. They just have a block around $50 million because it's a really big number, right? It's $1 million a week. And I joke about that, but I went back and looked at one of our previous deals, the first one that I was pitching as CEO, and I looked at that and my revenue projections went up to $47 million. So there's some mental barrier there. I certainly have shown it. You'll probably see it in your own deals. Next item would be the funding sought. So you're pitching investors to get money, to get funding. So it seems obvious, but you got to say, hey, this is what we're looking for. This is how much money we're looking for. This is why we're looking for this amount of money, so-called use of funds. And what are your plans for future funding? A lot of capital efficient angel deals do not need any follow-on rounds. Others of them need $500,000 now, but they're never going to be successful unless they get $50 million in the future. Those are two very different investment decisions. So investors are thinking, is this the right amount of money to be seeking? Sometimes companies look too small and they're thinking about they just need a little bit of money to do something. Maybe that's right, maybe they should seek more. And then we're also talking about financing risk. There are significant areas in the marketplace where the financing risk might be the biggest issue. And if you've been through a down cycle, a great company may be doing everything they say, and they're still going to die because they just can't get the money that they need in order to be profitable because the economy turned around. So the other parts that I look for is this an appropriate angel investment? So to me, angel investments are companies that can get going for less than $1 million initially, and then maybe a little bit more than that in total, maybe 5-ish or something like that. But to me, if you need $50 million to really get your company going, you probably want to start going down the route of VC earlier rather than later, and make sure that it's making sense. And then the other part about this is every angel investor is making personal decisions with his or her wealth, and timing may be off. The portfolio may have you may already have an investment in something similar, whatever that is. And that doesn't mean that the entrepreneur's company is bad. It's just that the individual investor's timing's off. So the next item that we would look at is, what is the deal being offered, right? So you got your funding sought, but we're looking for what, right? So pre-money valuation in some range of your pre-money valuation is super important. Some people don't want to commit to that because they don't have any negotiations going and they don't want to say the first word. But at some point, you also don't want to get thrown out because you're thinking about something as truly ridiculous valuations that some people have. And then also major terms, preferred equity, convertible notes, some other thing, whatever that is, should be disclosed so at least people know what's going on. And then to me, the most important thing is, what is the status of your investor traction? Because a deal where the entrepreneur is presenting to this group of angels for the first time, kind of has a valuation range, kind of knows what terms they are asking for, but nobody has actually written a check yet, is a very different deal than a team that comes in and says, look, we're raising $750,000. As of this morning, we have $600,000 in the bank, and we're just looking to close the last 150. Means that all the terms have been figured out, the pre-money's figured out. It's very simple investment decision. You either want to accept this one or not. There's not going to be a negotiation. So investors will be thinking, is the price fair? How much time is this going to take? What kind of investor protections exist, right? And then in my view, there's a lot of bad advice. So convertible notes make all kinds of sense in some areas, but not others. Safes make all kinds of sense in some areas, but not others. My thing is when somebody comes in and says, well, Y Combinator's doing this. Well, Y Combinator is special, right? They're doing their own thing, and that's totally cool for them. However, that doesn't mean that all deals need to emulate them. And then finally, the more complicated the deal, the more likely it is to fail. So simple deals get done, and complicated deals that are hard to understand and might have some potential upside usually don't get any traction. Then we get to talk about the exit. And so an exit is a liquidity event. So that's the way the investor gets their money back. That's what an exit means, and that doesn't mean the investor goes away. If the exit's an IPO, then the investor may keep their stock, but it's liquid. They can actually sell it and get more money than they had before. That's what we call a positive exit, right? So the entrepreneurial team has to show that they understand what an exit looks like. They've talked to people, they've done them themselves, whatever it is. They need to show that they understand what an exit looks like. Those are typically driven by current industry multipliers. It's a good way to kind of get an idea of the costs associated. The enterprise value drivers, what causes a company to pay more than a financial driven exercise for a company, right? What kind of strategic technology or strategic relationships does that startup have that makes it so much more valuable? And then finally, the timing of what that may be, right? Some of these deals are very near term and very short. Some of them are very long. That's what the entrepreneurial team needs to present, what their thoughts of that exit looks like. And then, investors are trying to figure out if it's if there's a chance that it's worth it, right? Most of these deals go south. Everybody knows that. Is there a chance that this is worth it? And then, two, is this a lifestyle business? And I want to be careful about lifestyle business. A lot of people talk about lifestyle businesses as, say, a business that is your canoe rental business. That means that you get to paddle on the river every day. Yes, that's a lifestyle business, but any business that isn't big enough to transact for a positive valuation for the investor is a lifestyle business in my view, right? So it's really, the question is this a transactable business? So a couple of things in my view, very clearly, once you take outside money, you've decided to sell your company in some way. You are no longer in control of your company. That's a very important decision to make. We, myself and the founding team at another company, we had a very long and very heartfelt and intense discussion about this, and we modeled out both ways of growing our business. One way through bootstrapping that business, which meant we owned all the stock, but it was a much smaller business in several years, and another way where we brought in some outside capital and grew this business substantially faster than we would have otherwise. However, we basically had to sell that company. I went through all the numbers. That was my job, and I said, look guys, I need you on board on this, because if we take the money, I can't get the investors the returns that they're looking for unless we transact the business. So I don't want anybody to think differently in the future. We had that conversation before we brought in the investment. It was a very smart conversation, and we never had any negative feelings, any negative conversations about we are on a track as soon as we bring the money in, and we did that. It was a great transaction. It was great for the founding team, the employees of the company that we sold, and we sold a good company when we did it. Another thing that we're looking at, especially in North Bay Angels, are redemption clauses for companies that might be possibly more in the lifestyle-ish, meaning non-transactable. These are clauses where the company buys back the stock from the investor at some point in the future for a pre-agreed amount. So that's an idea. If you have a company, North Bay Angels has been trying to figure out how to help these companies and good entrepreneurs with teams and ideas that will likely be successful, will likely add value to the local economy and the entrepreneurial ecosystem, but probably will not be sold at a high valuation. And a redemption clause is a way to get through that problem and make it worthwhile for an exit. The other part, the $50 million acquisition barrier, the advice that I generally give is that if your company is worth $50 million in revenue or has $5 million in EBIT, then your company has a market to financial investors, the classic private equity people. There's a general market for companies that are doing at least $50 million in revenue or at least $5 million in EBIT that can be sold for not a great valuation. You know, these guys are professionals, but you will be able to sell the company and provide an exit for your investors. We're just reaching the end on this. I have one slide on required charts, really just because it's frustrating, right? If the group that you're presenting to has a required chart, then it's required. It's simple, right? If you can't figure out how to put that in, it doesn't bode well. Then Q&A is the other part. Q&A, a lot of good deals are lost on Q&A. And the reason for that is investors are saying, this is the time we see the team try to sell us, and if they can't sell us, they won't be able to sell employees, they won't be able to sell partners or customers. So it's a test of answers and teamwork. My only view on this one is practice really helps. You know, showing your presentation deck to people that are really smart and sophisticated in that area, they will ask questions, and if you keep showing it until you kind of get the same questions, you will have good answers for those questions figured out before you're doing this in front of a group of people and you're out of time. I thought I'd add in here. This is what we call the NBA last slide. This is the last slide that is supposed to be put up in front of the investors while the entrepreneur is getting off the stage, if you will, right? And this has the 4 items in there that we were really frustrated by because we didn't see these in presentations and we couldn't make an investment decision. So it was a complete waste of both the entrepreneur's time and the investor's time to have them up there. They didn't have their financials, they didn't talk about the business environment, they didn't talk about the exit, and they didn't talk about the deal. If all of those things aren't in there, we can't make an investment decision. So we chose to put this little quad chart together. It's a required chart for North Bay Angels, and it's really helpful for us. So that brings my presentation to a close. As a summary, what I wanted to talk about is we kind of have 10 things that are important here plus required charts. So the overview, what's the company, why invest? Where's that market pain and how's the market fit? What's your competition and why are you better than them in what areas? Where you're at in product development, how you're going to get into that market, your marketing strategy and your status against that strategy, why you and your team are the team to do it, why you guys are going to win. The financials, past financials and future. What funding are you looking for? What's the use of that funding? What's the future financing? The deal that's being offered and how much traction is against that deal right now. And then your exit. Finally, required charts are just that. And practice your Q&A. It's really important. With that, I'm available for a little bit for questions. I believe Kim.
Thank you so much, Che. Yep. Thank you so much, Che. You have certainly provided us an outstanding and very comprehensive overview and a lot for us to digest. While we wait for people to kind of get their thoughts together and begin to submit some questions, we've got a couple already, and I think you may have already or just elaborated on this one, but the first one is really how do you prepare for the investor Q&A, and is that just practice, or are there other types of activities that management teams and entrepreneurs should be doing to prepare for investor Q&A?
So there's a lot of stuff that can be prepared for from a Q&A point of view. One of the things that obviously can be done, and we see this, is the people that have been through some kind of accelerator or training program. Here in Marin, there's Venture Greenhouse as an example. That's a training program where they pepper you with questions, and that will really help you be good at those and just understand how to absorb a question from the audience and how to respond to that question in an appropriate way. Most fun for how to absorb an off-the-wall question that isn't really appropriate in the beginning, but you have to field that question because the management team is going to have to do that in front of customers, etc. So practice helps, but there's lots of opportunities to practice. I like to tell personal stories because I feel like they're the most educational. For the deal that we raised money on just in the last few months, years ago, when I was looking at just the investment hypothesis, if you will, the why this was a good idea, I brought that to a couple of really smart friends of mine and said, okay, we're going to put some money into this, and we already have put some money into this. We're thinking about putting some more money into this. I would love you guys to be able to poke holes in this now, because there's no good for us to say nice things now and have an unsuccessful company in a few years. It's a complete waste of time. And we had those meetings years before we ever went in front of a true angel group, right? And I would recommend that from the beginning, right? A lot of people don't want to share their ideas, and there's some challenges with that. You have to be really careful. You have to make sure you have the right relationships and the right trust in place and all that kind of stuff. But at the same time, it's terrible when you see somebody go out and work on their business for 2 or 3 years and then come out with the same product that had already been built and failed in the marketplace. So that's the best advice I have.
That's awesome. Going back to the overview slide in the pitch deck, what aspects will really hurt that slide? Is it too busy? Is it too wordy? I mean, what is the best way to be both comprehensive and informative and not be too busy? Or does it matter?
It matters a lot. So I like to throw engineers under the bus because I am one, and I used to make slides that would be in 12-point type to try to explain every little thing and to make sure that everyone understood that I had thought through all of the predictable negative consequences of some statement that I had made, and then I had my backup. And so we'd have these slides that were basically a typewritten page out of a Word document that was blasted up on the wall 50 feet away, and you can't see anything, right? So the overview slide is a test of focus, and I think it's important, but we rarely see good ones. But it really explains what the group is doing. To throw engineers under the bus, I often see the more technical groups will have many paragraphs of words up on a slide, and somebody 50 feet away, there's no way they're going to be able to see it. So what it means is not only can they not really cull out what's truly important about their company to the investor and to the customer, but they can't even figure out how to present that idea. If you start out with that as your first slide, I would suggest that you're better off to not present it at all.
Okay. Here's one about the financials. The question is, should financials show how owners or managers will get paid?
For an angel presentation like this, it's not necessary. In fact, if there's a reason to mention that, I would probably do it verbally, such as a reason to mention that would be things like, I'm so-and-so, I'm going to be running this deal. I will not be taking a salary until the company is at this revenue rate or whatever. Or, I'm so-and-so and I need to at least pay a little bit, but I'm going to pay myself half market rate. You might talk about those kinds of things if it's a positive, but that would be far too detailed for the financials. Really what we're looking for in the financial section is what is the entrepreneurial management team's vision of this company? How does it grow? What drives that growth? And then most importantly, is this company, if it's successful, is that going to lead to a transactable company, right? So companies that in 5 years hope to be $10 million and even making $1 million to the bottom line, that's a fantastic company to own, but it's not a great company to be an investor in because it's really not transactable.
Okay, excellent. Going back to the winning team, if a team has not yet worked together, how much will this hurt them, and what can they do or say that will help convey to the prospective investors that they are a cohesive management team?
So I think obviously the best thing is to have a team that's worked together, but most people don't have that luxury in their team. So the best way to do that, to show that this team can work together and stick together, is one, through stories. Effectively, we had this challenge, this is how we overcame this challenge, and to talk about that. And through that process, it becomes pretty clear what the values and character are of the various people on board. And then the other part about it is a lot of teams will get into trouble about power and decision making and who's helping who and all this kinds of stuff. That's pretty readily apparent. Everybody who has seen a group of people work well together, and they've seen people that are obviously frustrated together. If you work well in the presentation together, if problems just become an opportunity for you and your team to show that you work really well together and you can fix anything, that's awesome. And that'll be a fun team to work with, and that'll be a team that sticks together.
Excellent. And our last question, because we are running out of time, is what is the best way to predict the market? How do investors go about making their own market predictions, or do they?
So one, there's two questions in there. So I'll talk quickly about the investor portion because that's a shorter answer, and then I'll talk about the team's ability to predict the market because that's a longer answer. So from an investor point of view, they will typically look to someone in their network that has some understanding of that market in order to get them to help understand if the team's vision and version of the market realities is true or not true. So typically an investor will lean on their own skill set or someone they know well skill set. So the next question is, how does the team learn to predict the market? So assuming that the team is outside of the market themselves and doesn't have a career's worth of experience in that, then the best way to do this is to go start talking to people who do have careers worth of experience in these markets. And so yes, there's the sales of the individual product that's important. That's certainly key. But there's also, if you're trying to build a company to sell, I strongly recommend talking to investment bankers that specialize in the particular space you're going into. They will understand the market dynamics about what kinds of things happen, what kinds of transactions happen, who the typical buyers are in any one of the spaces, why they buy companies, all that kind of stuff. If you can take somebody out to lunch, they'll probably tell you a lot. You have to do that enough times until you can start anticipating what people are saying, and that's a really good way. The other really good way is your web research now is so much easier than it used to be. You have all of these companies that they'll talk about what their goals are for their investors. If they're a public company, they'll say this is where we're going, this is what's important, this is where we think this market is. That's hugely great information. And then the trade shows are also fantastic. That's where they position their products and say, hey, the market's doing this and this is why our product's the best. I personally feel like an entrepreneurial team needs a couple of years to really get that understood, but they probably will have a couple of years to get that figured out. So, you go down and say you go to the big trade show for whatever the spaces you're working in. With my groups, with my team, we talk about what we expect to see and where we expect to see it every big show we go to see if we're right. And when we're mostly right, that means we're probably doing a pretty good job of predicting the market. It comes over time. It takes a long time, but it's hugely important.
Well, really appreciate it. Che, thank you so much. Couple of things to remember is kind of from my takeaways is really respect the people and the process. Don't be too good for the process. Be clear, concise, and complete. I love the no competition could mean that there's no market. And your comment about risk and risk retirement, of course, in the banking industry, we like to look at risk mitigation. So I actually may adopt risk retirement as a substitute. I'd like to thank again our presenter, Che Voigt of North Bay Angels, for providing this insight into the minds of investors. If you have any additional information or additional questions for Che, his contact information is available in this presentation. We will be sending you a recording of this presentation as well as a webinar survey. Your feedback is always appreciated. Please join us for our upcoming events Monday, June 22nd. If you're in the North Bay, at the Corte Madera Community Room is the North Bay Startup Grind. Startup Grind is a global startup community designed to educate, inspire, and connect entrepreneurs. I will be sharing my life as an entrepreneur, both as the CEO of Community Bank as well as the founder of Breakaway Funding. Then we're back here again on June 25th at 11 a.m. We have Mark Roderick, an attorney of Flaster and Greenberg, who will be talking about using crowdfunding to fund real estate projects. And then next month, in July, or the following month, July 23rd, we will be talking about the double D, due diligence, featuring Michael Gralnick, the chair of Kritsu Forum's Due Diligence Committee. I want to thank you all again for being with us today. We hope you have found the presentation very informative and valuable, and we'll look forward to seeing you next time.